Hey everybody, it's Mike from Orderflows, and in this video I'm going to talk a little bit more about order flow inverse imbalances. Now, over the weekend I did a training on inverse imbalances as well as value areas, and I want to talk about inverse imbalances today. This is April 7th, 2022, because today there were quite a few in several markets early on. Now, if you're not familiar with what an inverse imbalance is, first I'll start with what a imbalance is in a footprint chart. In a footprint chart, in the two-way auction, when you have more aggressive traders on one side by a ratio of usually 4-to-1. Again, you could change it to whatever ratio you like, but most traders use 4-to-1. Now, when you have three or more imbalances in a bar that are coming sequentially, one right after the other, so basically neatly stacked on top of each other, that would be called a stacked imbalance. Now, with stacked imbalances, you have bullish ones, you have bearish ones. Now, a stacked buying imbalance would be, an up candle, a green candle with three buying imbalances or more that are stacked neatly on top of each other at each level. A stacked selling imbalance would be three or more selling imbalances stacked neatly on top of each other in the down candle. Now, an inverse imbalance is a stacked imbalance, but with a bit of a twist. So a bullish inverse imbalance would be a stacked selling imbalance in an up bar, because normally you would expect to see a stacked selling imbalance in a down bar. And a bearish inverse imbalance would be a stacked buying imbalance in a down bar. Again, normally you would expect to see a stacked buying imbalance in an up bar, right? Because aggressive buyers are lifting the offers and taking the market higher. However, when you see an inverse imbalance, it is generally a sign of traders that are getting trapped in the market, right? They're aggressive traders that are selling into strong passive bids or buying from strong passive offers. So let's take a look at the charts today. So this is the MES, the micro E-minis, and at this low here, the low of the day at this time, I believe we did make lower lows, coming down into 44.52.5, right? You see this nice stacked selling imbalance, okay? The market was coming down, right? It had dropped, made new lows, boom, aggressive sellers came in here. This is probably most likely a stop that just got triggered down here at 53, and then the market snapped back and rallied up. Now, technically, we would consider these sellers, the people that sold into this low here, trapped. But again, it's not an overwhelming amount of trapped traders. You're talking 76, 70, 28. So that's what 146. About 100 and close to about 175 contracts. So there's plenty of time for them to get out up here. It's not like this little amount of trap traders is going to cause this 10-point rally. There's plenty of time for 175 contracts to be covered anywhere in here. But really what you're looking for is a sign that this low, or I'll show you later, a stacked a bearish inverse imbalance, which means the aggressive traders were caught offsides. But what it's indicative is a market that's snapping. It has a quick move down and snaps back, right? It means these prices down here are rejected and the market immediately comes back, and you could ride it on the way back up, right? And there's a nice move. Next bar obviously up, and then you got that little further push up here as well, back up to 70. And let me see. I'm not sure if there was one earlier in this day, but yesterday, Wednesday, I believe there was one. Let me just scroll back here, right? This one happened, right after the cash close, and you'll notice, it was just this little snap up here, market snap back, then went sideways, cash closed. You'll notice how the market came right back up to those levels that it rejected, right? These are areas. Let me put this crosshairs up here. This area got rejected pretty quick. Market came off, market came back up to this area of rejection. And what happens, right? It rejected it earlier. It's rejecting it again. Sold off going into this futures close, and the futures reopened. Quick move down to 70.25. Rejected these lower prices, and again started trading higher. Right? This is 71.25. You'll notice we came down to 74. We didn't really come down into it till much later and take it out. So, that was another sign of rejection. Let me see if there was any more during the regular session. Well, there was this one right off the cash open, not cash open, the FOMC, right? The knee-jerk reaction up, knee-jerk reaction down, and market went back up, right? Eventually it did come back down, but again, doesn't look like much of a move. Again, you're probably not going to be trading FOMC announcement, but you got the rejection early on, rejection a minute later, and the market continued in that direction a little further up before, subsiding back down. Now, let's take a look at another market. Take a look at NASDAQ, take a look at Mini Russell. Just give it a second here to come up. What is the Mini Russell here? Today in Mini Russell, all right, we have this move up. Up here, you've got an inverse imbalance. This is a bearish one. How do I know it's bearish? Well, it's the red candle. You got those stack buying imbalances. Now, we have this coded into the Orderflows trader software, right? So that you'll see where the bearish inverse imbalances are and the bullish inverse imbalances are, so that you can just very quickly just see it on the chart. Oh yeah, there I have it, rather than I got to analyze, look closer at the chart and see that. You see that, and so there's your inverse imbalance. It just prints right up there. You can't miss it. It's sort of like a lighthouse shining a light, and the market sold off down into new lows. How about mini Dow YM this morning? Again, today is April 7th. See if there's anything in here. Okay, here about 950, right? We hit those new lows, start going sideways. Let me just open this chart up a little bit more. We're going sideways. Market pushes down, rejects these lower prices again, because our low for the day is at 34,093, and you're just trying to keep testing these lows here, right? You came down in this bar, got all the way down to 97, so it was at 4 ticks off the low, and then just keeps going sideways, and then you get that last push down, and then it just snaps back really quick and puts in this nice rally up. Now, question people will ask, well, how do you trade these? Well, if you have this, you see this as soon as it forms, right? You don't have to wait for the bar to close to see it form, because you're seeing this in real time. How you trade it is you just wait for this bar to close, or where it's going to be, already the high is 120. You just drop in a buy stop, 122, 123, right up in here. Let the market take you in. If this market starts to go sideways and doesn't go any higher, then you're not going to get into the trade, right? If you don't want to just, I got the inverse imbalance here, a bullish inverse imbalance, I just immediately get long, because there's going to be times where the next bar just sort of goes inside and just sort of goes sideways and falls down, right? You want to let the market take you into the trade. I like to, set my entry, a couple ticks above the high of the bar for a long with the inverse imbalance. So you got the inverse imbalance showing right here. So I'll just drop in a buy stop just right in here. I'm ready to go. I don't have to necessarily wait. I can see as we're making these highs, I can just be ready with a stop already up here at 23 and just move it down as we start getting closer to the close of the bar. Just as you would, for that sell in the mini Dow, in the Russell. That was the mini Dow I was just talking about. Let's go back here, right? So, okay, I know I got my stacked inverse imbalance, and again, this is a 1 minute chart. You could find inverse imbalances on tick based charts, whether you use like a 100 tick chart or a 50 tick chart or a 200 tick chart, or if you're into fibs, 233 tick chart, a volume based chart, a range based chart. If there's an inverse imbalance, it will appear. So I would just be ready to drop in my sell stop right in here around 90, and the low of this bar is what, 91.1. Just drop in a sell stop, 90.9, 90.8. Now it did pull back a bit up, right, but didn't get back up to that inverse imbalance where it rejected those prices, and then just sort of went sideways before it fell over and had a nice move down and further. So again, look for those inverse imbalances, whatever market you're trading. They sometimes, you might not get one for a day, and then the next day you get two or three. It really, it just varies on market conditions. So if you like this video and, and want to see more videos like this, be sure to subscribe, hit the like button, but, make sure you subscribe so you'll be notified when I post new videos. I'm trying to be more proactive and posting more videos just to get this education out there for everybody. So have a great day, everybody, and bye-bye.